This is a true story, right? When I first got started in trading, right, I was new to it, right? Just learned about price action trading, and I would look at a chart, a naked price chart, and I see, the market breaks out. Strong bullish momentum, right? You can imagine the candles, right? They are so large, right? And I think to myself, man, the breakout is real, right? It's time to go long. It's time to buy because, I don't want to miss, any more of the move. So I buy. And then what happens is that shortly afterwards, the market reverse. And I cut my trade and I suffered a loss. And I was stubborn. I was, an idiot, right? I keep doing this for many times, right? I lost track the number of times I've did this, right? Every time the market staged a strong rally, the stronger the momentum, the larger the candles, you can be sure I would buy that kind of breakout. And I lost money consistently. And it's only, right, after being in the trenches for years, I kind of realized that, hey, chasing this type of breakouts is a losing money proposition, right? So now the question is, right, how do you actually avoid false breakout? And that's what today's video is all about. Okay, before we get started, right, I want you to do two things. Number one, subscribe to my YouTube channel. There's a link below. Just click on it, subscribe to it, right, and hit the thumbs up button. This way, you'll always stay up to date whenever I publish a new video. Have you done it? Okay, then let's begin. So firstly, how do you avoid false breakout? The first thing to let you know is that there's no way you can avoid false breakout completely. There are certain times, right, certain percentage, right, that no matter how good the setup is, you are still going to get caught on a false breakout. But you can minimize, right, the chances of you, getting caught in a false breakout. So the first tip that I have for you is number one, stop chasing parabolic moves, right? So what are parabolic moves? So parabolic moves, they are in essence, right, what I've just described earlier. The price, it moves up like this, right, with little to no pullback, right? Just a little to no pullback, and then it goes up higher. This type of breakout, this type of big ballistic strong momentum move, don't chase this type of breakout because more often than not, the market will reverse. Why is that, right? Let me give you a simple explanation why this usually occurs. When you chase a market where, it's making a strong move, a parabolic move like this, there is no floor to support these higher prices. If you compare to, markets that exhibit this type of price action, it goes up, retrace, goes up, this retrace goes up. This type of price action, right, there are levels like swing lows, right, to support these higher prices. This means, right, if the market were to reverse, right, it would find floor, it would find a support, right, where potential buying pressure could push the price higher. So this type of move are more sustainable because there are a series of, higher floors along the way to support these higher prices. Unlike this type of strong parabolic move, right, that goes straight to the moon, those are the type of breakout trades that are likely to fail. So let me share with you a few examples. So the first one that I want to share with you, right, is it's a good one because it just happened recently, right? It's natural gas. If you look at this chart of natural gas, right, at this point in time, right, do you want to be buying at this point in time? Well, if the old Rainer, you can be sure I would buy this market right now. After all, it's bullish, it's parabolic, right? Look at the strength of the momentum, right? And I need to slap myself, right, and wake up because no, I will not do that anymore, right? Because on experience, right, based on the my own trading account, the rateness of it, right, I know that this in the long run is a losing proposition, right? So what happens is that the market has gone parabolic. If you want to buy now, it's too late. In fact, you want to stay away. If you're not in the trade, stay away, stay on the sidelines. Because two things. Number one, I shared with you. There's a good chance that if the reversal comes, it can be very swift towards the downside, right? Back to this nearest support or floor area where buyers could come in. And the nearest area would possibly be somewhere here, right? Here where previous resistance could act as support. So it's going to be a huge distance, right? Where the reversal can, reverse quite a long way down. Okay, so that's one. Number two, if you were to buy a breakout at this point in time, ask yourself, right, where is a logical level to put a stop loss? If you ask me, right, the nearest market structure, the nearest floor of support is, I would say, somewhere here. So your stop loss, in essence, would have to be this wide. And from a risk to reward perspective, it doesn't make sense because for you to earn your initial risk, which is this part over here, your initial risk, The market has to move this much in your favor for you to earn, 1R, which is basically a one-time your initial risk. If you risk $500 on this wide distance as your stop loss, the market has to move this much just for you to make $500. So a wide stop loss, right, in essence, gives you a very unfavorable risk to reward, right? So this is one example of natural gas. Stop chasing, right, markets like this, right? You will eventually thank yourself, right, that you don't make this kind of a poor breakout choice in future. Another example that I want to share is this one here. Let's find it. New Zealand yen. Okay. So if you look at this, right, again, this one, the magnitude is not as large, but the concept is the same. You don't want to be chasing breakouts after the market has made a strong momentum move. For example, this one over here, strong momentum move, right, towards the upside, breakout, right? If you see such breakouts, tell yourself, right, I'm not going to chase it, right? Market did eventually reverse down lower. Again, look at the momentum move towards the downside. Very strong momentum move towards the downside. You don't want to be chasing this type of breakouts again, right? As I mentioned, because if it reverses, right, it can reverse quickly towards the upside against your position. And number two, to set a stop loss on such a trade, right, it's going to be very wide because your stop loss has to go above this market structure, this high, and your stop loss is very wide, which results in a very poor risk to reward on your trade. Okay, let me just share another example with you, right, on how not to trade breakouts, right? If you just, implement this one tip, right, I can assure you your breakout trades, right, will be much more profitable going forward. The last example that I want to share is this one, Bitcoin, right? So Bitcoin, if you recall, right, the mania, right, up to 20,000 again. If you look at the charts, it's very similar to natural gas. Look at this. This type of price action, right? Big bullish candles, stop chasing the market. It's too late to enter, right? And true enough, in this case, the market went up a little bit higher. You might see a little bit of profits on your trade before it collapsed all the way down to like $5,500 at this point of doing this video. So this is the first tip that I have for you, right? Don't chase breakouts. Okay, so now some of you might be wondering, hey Rainer, okay, I won't chase breakouts. So how do I trade breakouts, right? Then I got one tip for you, right? You want to be trading breakouts with a build up. So what is a build up? So a build up, right, means, right, the market is in a consolidation. So build up can go three ways, right? Let me explain, right? It can be a series of higher lows into resistance, looking somewhat like a ascending triangle. It can be a lower high coming into support, looking like a descending triangle. Or it can be just, consolidation. Let's call it C, right? Which looks like consolidation like this, a tight consolidation. Let's call it TC. A tight consolidation at market structure like support resistance. So I'm going to share with you a few examples of, how you can trade breakouts with a build up. So over here, okay, so since we are on Bitcoin, right, okay, let's look at Bitcoin. So if you zoom out Bitcoin, right, you can see that this market is actually forming a descending triangle, a form of a build up. Notice if I just connect the highs over here, it's not going to be precise, right, because I'm using freehand, but you get the idea. Notice the range of this market is getting tighter and tighter. The build up, right, it's forming. If you look at the range of this market over here, compared to here, compared to here, compared to here, here, and here, you'll see that the range, right, the candles, the size of this candles in this market is getting smaller. Up to a point over here where it's pretty much, right, not even moving anymore, like a dead patient. Right, when dead. So you can see that when you trade breakouts, you want to see this phenomenon. You want to see the range of the candles getting tighter. In fact, this is actually the opposite, right, of what I just said earlier. You want to avoid trading breakouts when there's large bullish momentum. In fact, you want to be trading breakouts when there is a build-up, when the range of the candles is getting smaller and smaller. In this case, you can see on Bitcoin, the range of the candles is just getting smaller and smaller. And today, we had a breakdown over here of this area of support. Okay, so this is what I call a build-up. In this case, it's in the form of a descending triangle, lower highs coming into support. And also from a price action perspective, right, just to add on a little bit of a tidbit. Notice, right, the buyers are getting weak, right? First time the buyers, they are very strong. They have no problem, right, pushing the price, from this low all the way to this highs. This much strength in the move. Then notice it get weaker and weaker, right? Then after which it just push this much. Then it push this much. Then this much, this much, this much, and finally this much. So you notice that each time the buyer try to push the price higher, the distance that they have moved, right, is getting smaller and smaller, telling you that, they're getting weak. Whereas the sellers, on the other hand, they are able to push the price lower, 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 and lower. And that's where you get your descending triangle. Okay, so that's one example of a build up. Let me share with you another one. Euro dollar, you can see this one over here. So just zoom back a little bit. You can see that over here we have another build up that's formed. This is the range. Okay, market did break out and then it forms a build up over here. This is a build up. So notice the consolidation over here is nice and tight. Okay, so this is a sign of strength. Why is that? Because when the price is at resistance, right? Usually, resistance is an area where selling pressure could exist to push the price lower. The fact that the market can hold up at resistance is telling you that, number one, either there is no selling pressure around, or number two, there are strong buyers, right, willing to buy at these higher prices. And whatever the case is, right, this is a sign of strength. And in this case, right, you can see that over here, this build up, right, the market did break out, it did reverse, right, and then finally break out higher again. So you can see that when you have a build up, right, you can actually reference, right, market structure, nearby market structure to set your stop loss. So this, is a swing low. You can set your stop loss like, 1 ATR below it, somewhere here. And this market structure is like a barrier to kind of prevent, right, the reversal from having a easy passage to go through. So you can see that in this case, the market structure, the swing low, did held up. Buyers came in again to push the price higher. Right, so this is what a build up can do. You have a tighter stop loss and you have a nearby market structure to hold up, right, the reversal or the pullback, right, should it come. Compared to, trading without a build up, as you just imagine, right, without a build up, just chase up here. When the market reverses, there is no floor, there's no level to support the higher prices. So this is why it's common to see the market reverse all the way down to the nearest market structure, which is this area of support. Right now, I hope you can see the lesson behind it, right? This is powerful stuff. Okay, so let's have a look at a few more examples. All right, that was a euro dollar. Another one that is worth looking. It's a bit of an exotic pair. Dollar against the Indian rupee. Right, same concept, build up and then break out. So you can see over here, this market in an uptrend. Okay, higher highs, higher lows, and then we went and formed a build up. Some people might say this is a bull flag, but whatever the case is, the naming of the pattern isn't important. The understanding of the price action is what matters. Notice the range of the candles getting tighter and tighter. This portion over here, right? The range of the candles getting tighter and tighter. It's like almost, right, they are running out of space to breathe, right? And usually when that happens, right, it's a sign that the market is about to break out. So there are a few, I understand some of you, right, who are new to trading, you might have difficulty trying to spot this tight consolidation. So one tip that I can share with you is you can use an indicator like the MACD. Okay, look at the histogram, right? You want to see the histogram, right, getting a flatter and flatter. This is a sign that the volatility of the market is shrinking. If you don't want to use the MACD, you can also use the average true range indicator. The concept is the same. Oh, okay. I run out of indicators to put on my chart. Let me just get out the average true range, right? The concept is the same. What you're looking for is at this point, right, is for the ATR values to be declining, telling you that the range of the market is getting tighter and tighter. So whichever you use is really up to you. But I think visually the MACD indicator it's easier to spot. So let's just go with it. Of course, there are other indicators, right, to help you identify the reduction in the volatility of the market. So go with whichever that you prefer, or if you're a price action trader, you can actually see this through your naked eye. Okay, so this is the one over here, right? Volatility shrinking over here. Look at the histogram, right, getting almost flatter. If you look at the one on Bitcoin, I think it's even more obvious. Bitcoin. Okay, so you can see over here, prior to the breakdown, right, notice, right, the range of this histogram getting flat over here. When there's volatility, right, notice the histogram, there's an obvious peak and trough. But when volatility has shrank, right, notice that it becomes like a dead ER patient, right? And then that's where you want to be trading the breakout, not trading the breakout when volatility is high, not when momentum is strong. Okay, so another tip to share with you is that whenever the market breaks out, if you see such strong momentum, right, where the histogram is at its peak, it's a sign to you that you want to stay away from the market. So if, for example, you saw earlier natural gas, right, let's just go back a little bit. Natural gas, right? If you look at the MACD, you can see that over here, strong momentum, right? Your MACD histogram is at its peak. This is a sign that you don't want to be chasing the breakout. And in fact, you just go back a little bit, right? In time, this one over here, okay, notice that the MACD, right, prior to the breakout, the MACD getting flat before it breaks out. Okay, so you can use the MACD to kind of help you identify build ups, identify momentum, so you can place better breakout trades. All right, so let's just have a look at one more example before we conclude this video. So I think the MACD one is something that you can use. I'm a price action trader, so usually I just, based on my naked eye, it's sufficient for me. But it's for those of you who are struggling with it, right, then that indicator could help you. So another one is just one last example, dollar Canadian, right? Another example of a build up. So just zoom back a little bit. Okay, over here. Notice over here, right? Where is the build up? Take 5 seconds to analyze. 1, 2, 3, 4, 5. So the build up is actually over here. I think most of you probably spotted, right? Build up at this area of resistance. So this is a sign of strength, right? Telling you the buyers are willing to buy at this higher prices. Notice the range of the candles getting smaller and smaller, and then after which, right, if you want to set your stop loss, right, you have a nearby market structure to lean against, which is actually this swing low over here. The market did break out in this case and happened to be a winning trade. Of course, it's a winning trade because I cherry pick a few of these charts to illustrate my point. Okay, so let's do a quick recap, right? What we have learned today, right? If you want to avoid false breakout, number one, stop chasing parabolic move, right? If you see a strong bullish momentum, you see the candles are getting larger. If you feel that something inside you says buy, it's a strong sign that you need to slap yourself. Just now that slap still hurt a little bit, right? I'm not going to do it again, but it's a sign to tell yourself that don't chase the parabolic move. I know it seems counterintuitive, but that's how the market works. That's how trading is like, right? Usually the things that it's easy to do is usually the wrong thing, all right? And I talk about how you should be trading breakouts. You want to trade breakouts with a build up. I explained to you what's a build up. It can be higher lows into resistance, lower highs into support, right? Just to do a quick demonstration, right? Higher lows into resistance, lower highs into support, or simply, right, just a tight consolidation at resistance or support, right? So this is how you would want to trade breakouts, and I promise you, right, if you follow these two tips that I just shared with you, you'll find that your breakout trading will improve dramatically. Okay, so with that said, if you want to learn more about my trading methodology, my strategies, my techniques, right, go down to my website, right, tradingwithrainer.com over here. Right, today we talk about breakout trading. So it's one aspect of price action trading. So if you want to learn more about market structure, support, resistance, price action, pullbacks, then go and download this guide over here, the ultimate guide to price action trading, right? Just click this blue button. Sorry, it's orange button. Okay, and I'll send this guide to your email for free, right? So this is the ultimate guide to price action trading. It will complement what you've just learned in today's video. And on the other hand, if you want to learn more about trends, right, riding massive trends in the market, right, in bull market, in bear market, then this guide over here, the ultimate trend following guide, is for you. Just click this orange button. It's free, and I'll send it to your email inbox. With that said, right, I wish you good luck and good trading. If you've enjoyed this video, hit the thumbs up button. Subscribe to my YouTube channel, and feedback, comment, just let me know below, and I'll be glad to help. So, I'll talk to you soon.